That's not a very good market. It's super thin. The best market has more and more and more transactions, more and more information's exchanged. Right? Hundreds of people come to the farmer's market to buy strawberries, figuring out the price of the strawberries. Millions of people buy and sell Apple stock every day. So they're getting a whole bunch of information about how much they want the Apple stock and what they think it's worth. Interestingly about markets, sometimes we think about them as having a physical location. Farmers market, Safeway, the farmers market. The market is a place where things are changed, are traded. New York Stock Exchange, Chicago Board of Trade are a place, are some sort of nexus of power. But a lot of times the market isn't there. The market just consists of people trading things. Like the housing market is completely disaggregated. It's everywhere at once, despite being, people exchanging actual physical property. Sometimes a market is a physical trade. There are goods exchanged, cash dollars for strawberries. A lot of times markets are not physical trades. People are trading strange electronic bits about what they think the future option value of some derivative is, and billions of dollars are people selling those option values. So there's a whole bunch of markets going on where nothing is actually traded. This is really important when we think about we're setting up environmental markets. Are physical things going to happen or not? Is there some sort of way to track between markets happening with Chicago Board of Trade for carbon and what's actually happening in terms of air quality? So a lot of what we'll talk about in this class is this idea of creating new markets. Environmental economics is, can we bring new markets to places that we don't have them yet? So a big one that we talk about as the example is a market for air quality. Tradable permits for sulfur dioxide pollution. Companies can buy and sell the permission to use the United States clean air to throw sulfur dioxide into it. And they have to buy permits to throw sulfur dioxide up there. If you decide to change to a natural gas electricity plant and give up your coal plant, you can sell a whole bunch of permits to other people because you're going to be done throwing sulfur dioxide up in the air. They're starting to do markets on water quality, and this is very tenuous and very hard to track the physical things. And I'll try and introduce this where there's a watershed. People are trying to improve the water quality in the watershed. There's a city that's got some problems with pollution, but they could pay the farmers upstream to put less nitrogen in. Let's plant some trees along the edge of your farm that's going to catch the nitrogen. Less nitrogen is going to go in the river. So here's where we have different marginal costs to provide this benefit. And so we'll have a trade because different people have different marginal costs. We've already talked about wolves, right? There are people who don't grow sheep in Wyoming that want there to be wolves. There are people that do ranch sheep in Wyoming that don't want wolves. There wasn't a market before, and we created a market for people who wanted wolves to pay the people for the sheep that were lost when the wolf ate them. So we'll think about this a whole lot. We're creating markets for environmental attributes where they weren't there before. I'll talk about this in another lecture, but we'll start with perfect competition. And where we are right now is this extreme case of perfect competition. If we relax those assumptions, then we can have monopolistic competition where firms might be competing but might work together to set a price. If we have a monopoly, there's one firm that's supplying the entire market, and their relationship to price is completely different. Monopolists can set the price. There's oligopoly where there's a few big firms that can get together and they can decide the price together. They sort of divide up the market amongst different firms. And monopsony is another case where there's a single buyer. They can decide what the price is because they're the only buyer in the market. What do we think about perfect competition? Many buyers and sellers. This is already stuff we talked about. Free entry and exit. Firms can come and go. There's no barriers to you participating. The product is relatively homogeneous. What you produce is the same as what I produce. And there's perfect information. So this is a big one. The information contained in the price has a whole bunch of information about your cost structures and about your opportunity cost of buying other things. So as an aside about economics, there's nothing in here about distribution, equity, inequality, where the income goes to. This is the tools of economics that aren't making value judgments about the morality of where the outcome is, just saying what the efficient allocations of resources is given this system. So we think about our markets. Safeway, okay, many buyers and sellers. Is there free entry and exit? It's a little sticky, like you can't just open up another Safeway. But in Berkeley, there's a lot of grocery stores. I don't go to Safeway, I go to other grocery stores. Product homogeneity, they're basically selling the same thing that other people are selling. Is there perfect information? Yeah, there's a whole bunch of different ways that consumers are getting information. They try and make this and this sticky. We talked about the club card and loyalty before. They try and make you just go to Safeway because there's I got my card and I get a deal and I'll get money off my gas. And they try and do a whole bunch of things that you're sticking with them more. Farmers market, many buyers and sellers. Can anybody go to the farmers market? You actually can't. In Berkeley, you have to apply to get in, but there are other farmers markets. Free entry and exit. Yeah, the same thing. You have to get into the farmers market at Berkeley. Product homogeneity. I would say at the farmers market, there's both product homogeneity and not. Like people will have a special niche thing. There's a person with 20 peaches. They have some peaches somebody else doesn't have. So that is an interesting angle. Perfect information. So farmers market is a good place to think about perfect information. There's seller after seller after seller. You just walk down. You figure out how much you want to pay for peaches or tomatoes, and you can see the different prices and circle back to the one you want. You're doing that information calculation. Oh, let's go to this other place. Their tomatoes look better for the same price. Big markets, the trillion-dollar markets, many buyers and sellers. Is there free entry and exit? That's sort of an interesting one. So if we think about this as millions of people just day trading, there's free entry and exit. I can open an account on my phone and start trading stocks as I walk out the door. The big players, who owns a seat on the New York Stock Exchange, who's got a seat at the table in the big way, there's only a certain number of investment banks, and there's less now than there were before. So it is sort of sticky. You can grow into the sector, but there are some big players controlling things. If you want to do an IPO, there's only a couple banks that you're going to go to for your IPO. Product homogeneity, that's an interesting one. So stocks, bonds, there's a whole bunch of different things that are traded. Now we're trading much weirder things like derivatives and credit default swaps and strange financial instruments that we know less about. There's less information. So this is this perfect information thing. If I want to get information about what Apple is worth or what Google is worth, there's tons of information. There's tons of information out there. If I want to get into some weird hedge fund information that's privately held by the hedge fund, and that's about some sort of derivative instruments, about pricing future contracts, there's less and less information. So within our financial markets, we have some with tons of information that anybody can access, and then we have other parts of this market that have a lot more opaque information. So our starting point is perfect competition because it's the most efficient point. And we'll talk about this word a whole bunch of times, but we're going to say it's the most efficient point. The prices are going to reflect the opportunity costs on the demand side and on the supply side. The information in those prices is meeting each other. We also have a thing we call that it's a Pareto optimal point. If we're at perfect competition, you can't change the price or quantity without making somebody worse off. Everybody has made themselves better off by getting to this equilibrium point. To leave this equilibrium point, we would leave this Pareto optimal point, and we would leave this efficient allocation point. So perfect competition, whether or not it's realistic, whether or not it actually happens, we say it's a starting point. We know where the efficient point is. So when we look at other market structures or we see problems in markets, we say we have some loss because we're not at that efficient point. So the cases that we want to look at here are environmental cases, natural resource cases. We're often not at that perfectly efficient point. But we want to say if we had a perfect competition case where things were efficiently allocated, where we had an efficient outcome from the societal perspective, how would we get there? What would it be? We have too much pollution. How do we get to the point where we have the societally efficient amount of pollution? We're losing biodiversity. Things are going extinct. What would be the right way to value the biodiversity of species so less would be going extinct at a lesser rate if there's some societally optimal choices to be made? So perfect competition, we're going to say, go back to this point that there's the short term and the long term. The firm is taking the price from the market. The market is setting the price. The demand of all the consumers is telling us the price. The firm is deciding internally their Q star from this internal cost structure of the firm. So we have price equals marginal cost in the firm, but we also have price equal to marginal revenue and average revenue, which are coming from the demand firm. The same price is giving us information about marginal costs and marginal revenues. So in the long term, this economic profits are zero, but wherever we are in the short term, we have profit maximization. So back to entry and exit, long run versus short run. In the long run, firms are adjusting how much capital this is. They're adjusting their contracts. They're adjusting how much space they've rented. And we have this long run price that's coming from each one of these is this minimum of our average cost curve. So long run, we're adjusting and we're adjusting and we're adjusting as we get bigger and bigger and bigger scale. As the market gets bigger, we have the minimum of average cost where we're driven out all of the profits. Profits go to zero in the long term. And so profits are zero at the bottom of this average cost curve. And this long run supply curve, long run average cost curve, where profits are zero, is our long run price. So we have some long run price where things are adjusting out. Each time market entry is going to drive profits to zero, drive us to a long run price. We talked about last time there's an average long run average cost curve that's going up. There's maybe it's sort of flat or maybe it's going down. In this case, we say we end up with a monopoly because a bigger and bigger firm is going to end up controlling things. What happens in this case is if you shake out all the smaller firms and end up with the one big firm, is that firm can then do things to keep a monopoly price that's higher than this long run average cost price. I already did returns to scale. Okay, so just on our maxims, I should wrap up, but we think that in perfect competition, firms are going to allocate all of the inputs that they use for production efficiently. They're going to take how much this marginal revenue product, how much output they get, convert that to how much dollars of output per unit of input they get, and they're going to efficiently allocate every single unit. Every single input will be allocated by how much it's adding to their bottom line, how much it's adding to their profit. So they're going to use inputs efficiently, and they're going to do outputs efficiently. Marginal cost equal to marginal revenue in the output market. So the consumers, as we did in the demand case, they have some sort of marginal utility for that good, and they're meeting in the output market, and they're efficiently allocating in this big market demand. So in the end, the price of goods, the price of the actual output good, has the marginal cost within the firm and the marginal utility within the consumer. So at an efficient place, the marginal cost to produce the good is going to be equal to the marginal utility for that last unit to the consumer. I guess I will wrap up there, and I will continue next time. I have all your problem sets, right? And I will tell you about the midterm on Thursday.